Alrighty, friends, welcome. So today we're going to be covering the basics of budgeting and investment. So when I talk about investments, I'm not talking about intraday trading or intra-week trading. I view that more as a potential means of income rather than long-term investments. And so when I talk about investments, I'm typically talking about mid and long term. In today's class, we're going to be talking about the basics. So that's going to be retirement type investments. And when I talk about budgeting, we're going to follow a very simple strategy, the 50-30-20 rule. So 50% of your income is going to be going to needs, 30% to wants, and 20% to investments. Obviously, the economy is, frankly, we're worse off than we were in the Great Depression as far as expenses compared to our income. So obviously the 50% to needs may be skewed quite a bit higher. And that's an unfortunate place to find yourself in. But I believe, and this is what I follow, and just to give you guys a quick briefing, I'm not a financial advisor, but this is what I follow and this is what I continuously strive to do. So 50% to needs, 30% to wants, 20% to investments. So if you guys, let me share my screen here for a moment. If you guys don't have a monthly budget set up for yourselves, I highly recommend using this free stuff. And this is actually what I use. Let me share entire screen. Boom, bada bang. All right. Let me know if you guys can see that. Hopefully you can. So if you jump on Google Sheets, so if you have a Google account, you have Google Sheets for free. And at the bottom right, when you jump into your monthly, your little deal, you can, let me see, back out. All you do is start a new project. Actually, let me back up for a moment. So when you guys first jump on, you're going to see file picker. So you can search for your, whatever it is, your own template. Look up monthly budget, and this is provided by Google. So this is essentially a really easy way to track all your expenses. I highly recommend it, and essentially it's very simple. And this is what a budget should look like. All your expenses, you can change all this. Like for food, for example, say for yourself, if you're single, you're spending, I don't know, $550 a month on food. And then whenever you actually get through your month and you see, I actually saved a little money, I spent $490 on food this month, and it will show you gain $60 from what you thought it was going to be. And then you'll have your paycheck of whatever it is, and then you'll get essentially an increase of your total savings per month. And I recommend in your expenses setting up your 20% for investments. So let's say you have a Roth IRA account and you set up auto draft for your Roth IRA account. So you don't even think about it's already built into your expenses. And let's say you're trying to max it out at, I believe it's $563. $563 a month. So that would already be built in to your expenses, and anything on top of that would just be going towards your savings, your crap fund, whatever it looks like. So whatever you choose to use as a budgeting software, whether it's a piece of paper and a pen or something like Google Sheets or on Excel, whatever it is, money is a very cruel mistress. And if you really don't pay attention to it, she will leave you very quickly. So I want you guys to be paying attention to your money. And it's just the absolute basics of financial literacy is knowing where your money is going, how much is coming in, how much is going out, and where it is being invested. So obviously when we talk about the basics of investments, it's going to be very basic. So we're going to be talking about the one fund investment strategy, which is going to be covering just contributions to a Roth IRA. But in long term, for many of us are relatively young, hopefully 20s, 30s, because, and I say hopefully, not because of any discontent to anyone a bit older, but it gives us so much time to watch compound interest really work. And try things that don't work and find stuff that does work for us. And so I'm talking about investing in hard assets like real estate, as well as continually planning and investing for your retirement funds with after-tax dollars and so on and so forth. But that is going to be in some future lessons. So talking about the basics, get yourself a budget and don't say, yeah, my expenses are, roughly $3,000 a month because it's my car, my food, my rent, my subscriptions, and that's it. But when you really dive into it, are you getting into your expenses, like your toiletries, if you go out quite a bit, is that budgeted in? All this stuff really, really does add up. And what I highly recommend is, if you guys don't have one, ChatGPT is free to sign up. Use ChatGPT, or if you want to save some time, you can do this manually as well. But just start running through, like, hey, I have, my deodorant, my soap, my shampoo, my conditioner. I probably restock every couple months or whatever it is. You go through, essentially walking through your house, seeing what you eat. You go through your pantry, what you're eating every month. You can really, really dial in your budget. And what that gives you the ability to do is now manage it, because all the measurements are there. You can see all the variables, and you can say, man, I'm spending way too much money on subscriptions per month. I really need a backup. I'm going to cancel 3 of them. I don't even watch Peacock or whatever it is, if you already finished The Office 10 times. So I highly recommend finding a software that is useful for you. This is free. Googlesheets.com. Go find it and make it, and use ChatGPT or something to really dial it in. You should see my budget. There's probably 30 different columns on this side, and it literally goes down to my toiletries, where my toothpaste is included, my floss. And I know that's a little bit, I want to be careful with my words here, but you can go as far as you want. I'm not one to, I love to live. I'm not, tomorrow's not guaranteed. So I'm not squeezing myself so tight that I'm not enjoying life. But money really is a cruel mistress, and she will walk away if you don't pay attention to her. So pay attention to your money, where it's going. And that is the basics of how to move in to what we're going to be talking about next, which is your investments. So let's talk about, so we know that ideally, and of course I want you guys to research this as well, but ideally 50% is going to needs, 30% to wants, and 20% to investments. And if we are continually striving to increase our income, then obviously the 50% of needs will start to dwindle, and more of that will go towards wants and investments. But let's say you're completely content with where you are. You really love your job, and you know that you probably won't get a substantial increase in your income. That's amazing. I'm so happy for you that you are content with where you're at. So what needs to happen then is really dial in your budget, see what can go out, or how much is coming in versus how much is going out, and how much you are able to invest. Because unfortunately, the older we get, the less time we have to plan, or we have to plan for not only our future, if we want to stop working, or at least become a little more comfortable, maybe work a little less, and maybe treat the kids, the grandkids, go on more vacations, whatever it looks like for you. We have multiple things fighting against us. Number one, I would say, is our inflation. And number two would be the kind of work it backwards, is compound interest is essentially disappears over, if we're 55 years old planning for retirement at 65, essentially that 10% yield you'll get from an index fund like the S&P 500 virtually disappears. And of course, it's good to still invest, but starting at 55 versus 18 is going to be substantially different. So there's a lot of stuff working against us. So I hope you guys, even if you are in a fixed income and you aren't looking to increase your income, start working on your budget so you can see what you can set out, what you can plan for vacations, and what you can plan for investments, because those investments are truly what's going to help you in the long term. It's not going to be your Social Security check that you get when you retire. That's not going to cover, especially if inflation continues to go up and Social Security stays stagnant. Sure, we'll see multiple increases over the years, but inflation is fighting us so much harder than we're combating with our Social Security checks. So that aside, that's the budgeting side of stuff. I want to talk about the very basics of investing for retirement. So we'll be covering the one fund investment strategy, which is essentially investing into one fund instead of it's still diversified, because we'll be talking about investing into an index fund, which take the Vanguard S&P 500, for example. We're investing into the top 500 companies and the NYSE. So when we do that, we're still diversifying, but it all is still stocks. We can go into the 2 fund and the 3 fund investment strategies, where you're going into 90% stocks and 10% bonds, and so on and so forth. And then we start talking about real estate and international bonds and whatnot. So we can go down that route in future classes if you guys are interested in it. But nonetheless, let's talk about the one fund investment strategy. So like we touched on briefly when talking about your budget, I highly recommend, regardless of how much expendable income you have, setting up auto draft for your investments. So before we jump into that, actually, let's talk about what we're going to be using as an account to invest. So I highly recommend, or I shouldn't say that, what I use personally, and I recommend you guys looking into, is a Roth IRA. And so a Roth IRA uses after tax dollars. So you can only invest your income. So I earn, let's say $1,000. I make $1,000 and that's taxed, and now it's mine. I'm able to contribute that to my Roth IRA account, and it is no longer going to be taxed regardless of how much it grows. So if that $1,000 turns into $1 million, that $1 million comes to me at the age of 60 or 59 and a half. If that account's been open for more than 5 years, that $1 million is just mine. There's no more taxes on it there's no capital gains. It's all yours. And that's what is so powerful about a Roth IRA account. There's really not anything else like it. Of course, you can go in the weeds of investments, and the higher up you go in the tax bracket, typically the more network you build around how to essentially avoid taxes. But this is a very straightforward way for anybody within a certain tax bracket to contribute and grow your investment tax-free. And that's why I use it, and that's why I recommend you guys looking into it as well. So we got it. The Roth IRA account uses after-tax dollars, so your investments grow tax-free, and you can pull that money out fee-free as well, so you're not paying any fees to the broker at 60 years old. So that's why I use it. So we'll talk a little bit about it. The max contribution for anyone under 50 years old, which I fall into, is $7,000 a year, which is roughly $583 and some change per month. So for some of us, that's totally doable. For some of us, that's really exceeding our budget. And that's okay, because you don't have to contribute the max. You can contribute as little, or I shouldn't say as much, as little as you want, up to $7,000 per year. So, and if you're over 50, the max contribution is $8,000 a year, which is $666 and some change. So if you guys fall into any of this, what I highly recommend you guys looking into, again, I'm not a financial advisor, but if you don't have one, look into it. Do yourself a favor. I recommend just Googling. I'm not going to go out and recommend the individual brokers that I use for my Roth IRA, because my needs are different than yours. So go just sit on Google and look up what is the best Roth IRA account. And you'll get a bunch of sponsors at the top, and then you'll get articles. Look through those articles. Go through a couple, because some of those articles are going to be directly written by whatever brokers they are. But look through them, find what works for you. Look at their fee for managing your fund. Some of them typically won't exceed 0.25%, which is fairly reasonable. Others are 0%. So just go on Google, look that stuff up for yourself. Do yourself a favor and say, what is the best Roth IRA account? And I'll put it in the chat for anyone who is unfamiliar and very new to this stuff. That's what you're going to be looking into Google, just Roth IRA. What is the best fund? So once you find a broker that you like, that's simple to use, open an account with them. It's typically going to be a little process. And once you do, some of them require an initial investment to start. Some of them don't. So look into that. If you don't have a bunch of money to throw in, make sure you don't need $2,500 to open the account, and make sure it's a lot less than that if you are someone on a tighter budget, but do want to get started in your long-term investments. So once you have your broker account set up with your Roth IRA and you looked it up on Google, you found the perfect one for you, you spend 30 minutes to an hour opening up. Hopefully it's quicker than that. Some of them are quicker, some of them you have to jump on the phone. So I digress. Anyway, when we talk about how powerful a Roth IRA is with tax or after tax dollars, and when you pull out, they're going to be tax free. So let's talk about the power of compound interest. So if any one of the chat is kind enough to throw out their age, I highly recommend it, but we'll take 25 to start if nobody wants to hear where they might be at. So if you max out your contributions and invest in the S&P 500, let's just go simple, the Vanguard S&P 500, starting at 25 years old, and you max it out until 65 years old, assuming and that's what the S&P 500 is returning on average right now over the last, or I shouldn't say right now, the average of the S&P 500 is 10.13% return per year. So if you invest for that $7,000 a year, $584 per month, starting at 25, and you invest for 40 years at that 10.13% return, you will have approximately $3.2 million in your account tax-free at the age of 65, with the investment being only $280,000. That return is, you don't see that anywhere else. And if you do, and we're talking about very simple math here, if you do see that return, you are paying anywhere from 30 to 60% in taxes. This is tax-free returns, folks. This stuff is super powerful, and I highly recommend you looking into it. But this is how, if you're a bit older and you're just getting into investing for the first time, time is not on your side when we're talking about compound interest. So let's just take so at 25 years old, you invest for 40 years, you have $3.2 million at $7,000 per year investment. If you start at 35 years old, assuming the same 10.13% return, you'll have $1.2 million for a $210,000 investment. So you just lost, in the 10 years from 25 to 35, you lost $2 million with the initial investment of only a $70,000 difference. $70,000 ended up being $2 million down 40 years down the road. So if you, regardless of your age, if you don't have a Roth IRA account, again, I'm not a financial advisor, but do yourself a favor and go look into it. Google what the best account is, open an account, and set up auto draft. Even if it's $20 a month and you have to buy one less six-pack of beer, or you go to one less meal per month, it is so worth it. And what that also does is you can put it into your budget. It's already disappearing. You don't have to look at your budget at the end of the month when everything's tight and say, ooh, I really don't have any money to put in my investment account. It's already gone. It's like a subscription. It's getting auto drafted. And as if you're on the younger side of this, let's say 25, 35, your income will increase. And then you can start going from maybe really tight $20 a month to maxing it out, or $300 a month. And even that will make such a difference down the road. Starting today is the best thing you can do for yourself. And we'll go one step further for the example here. So again, at 25 years old, if you max out your contributions in that Vanguard S&P 500, you'll have $3.2 million. If you start at 35, you have $1.2 million. If you start at 45, you will have $410,000. You can see how powerful, and that's for a $140,000 investment. How powerful is compound investment to be able to look at this and be able to take that out tax-free and fee-free. It's your money. There's no strings attached. So this stuff is really, really powerful, and I hope you guys are looking into it. And this is just for, again, this is a one fund investment strategy. This is only if you just put that money into the S&P, the Vanguard S&P 500 at a 10.13% return, and that's what it would look like in 40 years if you're 25 years old. But we know that we can do a bit more research and pull a little bit more out of the market, maybe 11, 12, 13% return. Some years we're going to have a lot better than worse. So this stuff is powerful. This stuff is for how much, if you're one of my American friends, and honestly, inflation is a problem worldwide, but for us Americans, we can see how bad inflation has been over the last couple of years because of how much the government is printing money, money that is no longer backed by gold. It is just fluff. It's just decreasing the value of our of the dollars in our pockets. So if we're not combating it, if we have all of our money going to a savings account, you're not saving anything. You're actually losing that money unless you're combating inflation rates, which every year it's different, but the last couple of years it's been around 7+% per year. So if you have $1 million in the bank, in the account, and you're like, oh, it's going to be great by the time I'm saving every month, and by the time I hit 65 I'm going to be totally chilling. But you're losing, in the last few years, 7% of that account, and you don't even realize it because the account balance just goes up, but the spending power of that goes down. So you guys have to be aware of this stuff, and this is how you combat it. Investments. How can I make my money work for me, and how can I get a return on this stuff? And it's super, super, I would say, necessary to do. So that's what I got for you guys today. This is truly just obviously the basics. We covered budgeting, how you should find a software that works for you. We went a little bit over the Google Sheets, and hoping, at least I am striving to get to the 50, 30, and 20% rule. 50% right now, or my needs, is swallowing up a little bit more than 50%, but that's okay. We're all working towards the goal. So we went over the basics of that. We went over the basics of your Roth IRA, how powerful compound interest is, and just the one fund investment strategy, which, again, to recap, is just putting your money into one fund, which, if you're going to do that, what I'm doing and what you should look into is just you can pick any index, but the Vanguard, for example, S&P 500 at 10.13% return. And by the way, there's other indexes that are returning higher than that. There's one recently, I'll have to find it for you guys, it's spitting out something like 12.5% since it's been open the last couple of years. Pretty powerful stuff. So the best time to start is today, and if not, the best time to start is tomorrow. So hopefully you guys got a little something out of this. Let me know if you guys want to see more of this. We can go into deeper and deeper strategies of investment and financial literacy, because as much money as, let's say, you become one of the best traders you can be, and you make a ton of money through what we're doing here and day trading and swing trading, and everything's working out really well. You can make a lot of money, but if you don't know what to do with that money, like I mentioned at the beginning of this, your money is a cruel mistress, and if you're not paying attention to her, she's going to walk right out the door. So absolutely, regardless of how much money you're making, you need to be financially literate. So that's why I started these classes. If you guys want to see more of them, let me know. If you guys want to see less, let me know. We're here for you guys. If you just want to talk about psychology, risk management, wellness, whatever it is, you let us know and we're going to make it happen. So I appreciate you guys a ton for joining up. I hope you guys do something hard today, and I hope you could look around and be proud of your actions and be proud of the relationships you have, and I hope you tell your loved ones that you love them. So appreciate you guys a ton, and I will catch you guys on Thursday. Peace.